The AresONE 1600GE platform positions Keysight at the critical choke point of next generation AI fabric validation, where 1.6 terabit Ethernet and 224G SerDes converge to define who owns the data center testing layer. Bull case: AresONE 1600GE, owning the AI fabric validation layer. Bullish investors argue that Keysight's launch of the AresONE 1600GE is not merely a product refresh, it is a strategic land grab for the most lucrative testing bottleneck in enterprise AI infrastructure. Every hyperscaler, cloud provider, and colocation operator building out next generation AI data centers must validate their switching fabrics before deploying at scale. Keysight now holds the most capable instrument to do exactly that. The 1.6 terabit Ethernet platform arrives precisely as the industry transitions away from legacy 400G and 800G interconnects toward 1.6T architectures required to feed clusters of next generation AI accelerators. With 224G SerDes at its core, the AresONE can emulate the extreme, bursty traffic patterns that characterize AI training and inferencing workloads, patterns that standard traffic generators fundamentally cannot replicate. You cannot sell a 1.6T fabric into a hyperscaler without validating it first. Keysight just became the only credible instrument at that speed. That is a toll booth, not a product line. Market dynamics: CapEx cycle timing and the enterprise adoption curve. The central debate among Keys observers is one of timing rather than direction. Few dispute that AI data center buildouts represent a multi year, multi trillion dollar infrastructure wave. The friction lies in forecasting precisely when enterprise and sovereign AI deployments will drive meaningful test equipment procurement cycles, and whether Keysight's revenue recognition will lead or lag the physical deployment curve. Hyperscalers, who tend to qualify test equipment earliest and in the largest volumes, are already engaging with 1.6T architectures in lab environments. This creates a potential pull forward dynamic where Keysight sees outsized early demand from the handful of marquee cloud operators, followed by a longer, slower tail of enterprise and Tier 2 colocation customers who adopt the same interconnect speeds 12 to 24 months later. Bears caution that Keysight's broader test and measurement business carries cyclical exposure to telecom and semiconductor capex, which remain compressed. The AI tailwind is real, but may not fully offset softness in legacy segments, at least not in the near term. Risk factors: competitive response and budget cycle headwinds. The bear case rests primarily on competitive dynamics and capital expenditure timing. Spirent, Ixia, now Keysight owned, but competitors exist in the broader ecosystem, and emerging players are all racing toward 1.6T capability. While Keysight holds a first mover advantage today, the window of exclusivity may be measured in quarters rather than years as rivals accelerate their own platform roadmaps. Additionally, enterprise IT budget cycles remain cautious in a higher for longer rate environment. Large scale data center fabric refreshes, the very projects that require AresONE class validation, are capital intensive decisions that procurement teams increasingly subject to extended approval timelines. For Keysight, this means the revenue realization from the AresONE launch may be more back half weighted than initial enthusiasm implies. Strategic analysis: the choke point strategy, validating AI at 1.6 terabit scale. Keysight's product strategy with AresONE reflects a deliberate choke point thesis. In any infrastructure transition, the test and validation layer captures durable, high margin revenue regardless of which switch silicon vendor, optics supplier, or server OEM ultimately wins. The company does not need to bet on which AI accelerator architecture prevails. It simply needs to be present when every new generation of interconnect is qualified. The move to 1.6T Ethernet is not incremental. It represents a step change in data center spine architecture, driven by the bandwidth demands of scale out AI clusters that link thousands of GPUs and TPUs in collective communication patterns. Validating these fabrics requires traffic generation at precisely the speeds and burst profiles that only a purpose built 1.6T platform can deliver, which is precisely where AresONE 1600GE sits. The 224G SerDes at its core is significant beyond raw throughput numbers. At this symbol rate, physical layer impairments, including inter-symbol interference, lane skew, and forward error correction margins, become the primary engineering risk in fabric deployment. Keysight's ability to characterize and stress these parameters positions the company as an indispensable partner to network silicon developers, switch vendors, and hyperscaler network engineering teams alike. Bulls envision a scenario where the AresONE platform becomes the de facto qualification standard for 1.6T Ethernet deployments globally, a position analogous to how Keysight's legacy instruments became the reference standard in RF and wireless testing. Once embedded in the qualification workflow of a hyperscaler or major equipment vendor, switching costs become prohibitively high, creating multi year revenue visibility that the market may be materially underpricing. At 224G SerDes, you are not buying a traffic generator. You are buying the instrument that tells you whether your billion-dollar fabric is safe to turn on.
Okay, the stock is up 1.93%. This is Tuesday, the 10th of March, 2026. Not a lot of shares have crossed the tape. Usually doesn't even trade a lot of shares. 1.39 is the 50-day average. We kept our eye on the stock, and today we checked, and there was something there. Okay, so we have the stock attempting to resume its uptrend. It's showing a lot of. It is strongly bullish, technically strongly bullish, attempting to resume the uptrend, still trending, even though it has corrected. It's attempting to, yeah, I've repeated myself so many times now. Okay, but the extrapolation is saying that higher prices are expected to remain in place up to the 20th of April. Yeah, up to the 20th of April, and projections are saying 243.63. So there's danger here. There's danger here. 243.63. Yeah, that might happen. That might happen. It's yeah, you can see this. It stopped retracing it on the. Let's see, it stopped retracing it on the 12th of February. And yesterday it printed it. Yesterday it printed it. Okay, so this one, maybe it may not print it anytime soon. It may not test it anytime soon, but it's something that might happen. Yeah, we have this algos. They just for some reason, when they print these downward projections, it just tends to happen. This didn't happen, and maybe expecting it to happen would be a stretch. Indeed, maybe this one may also be a stretch as well. Yeah, so momentum is expected to remain subdued, at least between now and the 17th of March. Maybe after that, it might spike up again, but not the sort of levels we saw or towards the end of last month. I don't think it has anything on its weekly chart. Let's see. On the weekly chart, nothing. Yeah, but yeah, it's not extrapolating anything. Not extrapolating a retest of this might be an all-time high, 52-week high in any case. Not not extrapolating that, more of a consolidation at least up to the 13th of July. Okay, let's see now. What we can do is just see what the moving averages are doing. This you can see here, momentum is expected to remain pretty much subdued. Nothing based on the 10-day moving average. This 10-day moving average is losing roughly 49 cents every day. Let's see what the other moving averages are doing, how they are aligning. Let's see. 21-day moving average. Is it aligning with yes, to some. Oh no, they're diverging. They maybe begin to diverge from. They are quite divergent, but for now, between now and the 17th of or 18th of this month, March, they are aligning the 10 and 21-day moving averages. Let's see what the other moving averages are doing. They are these two, the 10 and 21, are saying that they may remain momentum may remain flat between now and the 18th or 19th of this month. Let's see what the 200 day, the 40 and the 200-day moving averages will be indicating. Okay, okay. Let's begin with the 40-day. It's currently, what is it doing now? The 40-day moving average. It's currently showing strength. It's saying that yeah, okay, pretty much up to the 16th, it might remain strong. Okay, up to the 13th, up to this Friday, might I think it just may remain strong, and that's also the case with the 200-day moving average. 200-day moving average is yeah, ultimately expected to continue to remain elevated, but may go flat from the 2nd of April. But the 40-day moving average is expected to begin to decline thereafter. So I think yeah. Okay, well, anyway, what we can see surely is that whatever is going to happen, the underlying trend is expected to remain intact. Yeah, whatever happens, underlying trend is expected to remain intact. This going by what we have here, you know. Yeah, so I think to some extent, these the 10 and 21 period moving averages, 10, 21, and 40, they are aligning, but the 200-day moving average is saying that yeah, fundament the underlying trend may remain pretty much stable. Yeah, we may remain may still remain bullish. Yeah, may still remain bullish. If anything, just neutral at some point. You know. Yeah, let's return again and see what we have there. Yeah, yeah. I think towards April we have the 10, 21, and the 40-day moving averages aligning, and then the 200-day moving average going just neutral. Okay, so that's what's going on right now, and see what you make of Keys, and thank you very much for watching this video.